Hello everybody, welcome to the Daily Financial Times. Today, we're going to be decoding the mysteries of financial statements. Whether you're a business owner, investor, or just a curious understanding, these documents is a game changer. Let's simplify this with clear examples so you can master the basics. Let's start with the income statement, also called the profit and loss statement. This document shows a company's revenues, expenses, and profits or losses over time. Here's an example. Let's say you own a retail store. Your store earns $500,000 in sales this year. That's your revenue. You spend $300,000 on salaries, rent, and inventory. These are your expenses. And subtracting these expenses from your revenue will lead you to $200,000. Now that's your net income. The number net income will show you how profitable your business is. Next, you have the balance sheet. It's the snapshot of what your business owes, and what's left for you as the owner. Now let's do this again. Let's say you have a store and it has $100,000 in cash, $50,000 in inventory, and equipment worth $30,000. Now these are your assets, but you also owe a $60,000 on a loan. Now that's a liability. Now subtract your liabilities from your assets. You have $180,000 worth assets, which is your $100,000 cash, $50,000 inventory, and $30,000 equipment, and $60,000 liability. If you subtract $180,000 from $60,000, you get $120,000. Now that is your equity. That's how much you, as the owner, have made. Then you have the cash flow statement. So the cash flow statement, which tracks where money flows in and out. Think of it as your financial roadmap. Let's say you have operating activities. You receive $20,000 from customers. That's the cash inflow. Now you spend $15,000 on the salaries. That's an outflow. Investing activities. If you decide to buy new equipment for $10,000, that's another outflow. And if you take a loan for $25,000, that's a cash inflow under financing. So how do you read and interpret financial statements? So let's talk about the basics. So let's talk about how to interpret these statements. Here are 3 tips with examples. Trend analysis. Compare statements from different periods. For example, if your revenue increased from $400,000 to $500,000 this year, that's a good sign. Then you have ratios. Using ratios to dig deeper. Let's calculate the profit margin. If your net income is $200,000 and your revenue is $500,000, then your profit margin is the same as your net income divided by revenue times 100, which is 40%. Now that's a very strong margin compared to an industry averaging of 30%. So profit margin just tells you how much of your revenue, what's the net income out of your revenue. And then you have benchmarking. This is where you compare your businesses to others. If competitors have higher profit margins, you can figure out how to improve. So financial statements might seem intimidating, but with practice, they're powerful tools. By mastering them, you can track profitability, stability, and growth, key to making smart decisions in businesses or investments. If you enjoyed this video, don't forget to like, comment, and subscribe. Let me know in the comments if you have any questions. Thank you.